Hi, Dominique. Welcome to another edition of the week ahead. It's good to have you back after the past 2 weeks. How's everything going? Obviously, as always, this was quite a pretty interesting week. So, yeah, how are you doing?
Fine, thank you. It's great to be back. And yes, lots of action both on the data side and market movement. So very exciting. Looking forward to the fall.
Okay, great. So, as we always like to do, let's kind of dig into what your biggest takeaways from any speeches, data, and obviously the market reactions. Um, and has any of it impacted your kind of general view and framework over the next kind of, let's say, 6 to 12 months?
Not too much. To me, the main event Fed-wise was the Jackson Hole speech of Chair Powell. It shows that he's more worried about disinflation than at the time of the July meeting. Growth is too fast in his view, and he was also concerned by wage inflation perking up, and certainly has less confidence on the stance of monetary policy being restrictive than in July. And I think the key reason for that is a sign of a growth strength. And this week we got mixed signals. Data-wise, we got very strong consumption and a decline in the savings rate, which is going back to the pre-financial crisis low. And I think that's a headache for the Fed, a new headache, because the US is 70% consumption. So if suddenly a household save less, if you are the Fed and you're trying to slow aggregate demand growth, you have a problem. So we
Okay,
had
so right now, in general, spending is higher than savings, or spending is higher than earnings.
so the,
So that's depleting the people's savings, which I think I remember Jamie Dimon kind of predicting by the end of the summer, most of the kind of all the stimulus payments, a lot of that stuff would be depleted. Is that
That's correct. But I think I think the market is, and with all due respect, Jamie Dimon is wrong on this one, because what's driving consumption is not excess saving; it's income and average savings, income growth going strong, and the thing is, the savings rate is falling. And what seems to be happening is that since households cannot borrow more to buy bigger houses, right, because they are locked in their low 30-year fixed mortgage rate. So what they've done is they've borrowed um, consumption. For consumption purposes, they have increased their credit card borrowing, for instance, and that's supporting growth. And in my view, it's yet another sign that monetary policy is not restrictive enough to slow the economy.
but
Um,
is there, and I'm sure people have a question like, so is there some waterfall, like some cliff edge where people are saying, oh wait, I didn't realize my savings rate, my savings is so low, and I'm not getting the bump up in wages than I thought, and that will slow the economy. Like, there's the sugar high, or I'm quite confident I could always move job, get higher, and then eventually it hits a point where, which I guess this was a concern for people like Jamie Dimon were saying, when those savings get low enough, that will actually make people change behavior. Hasn't happened so far, but is there a point that we hit that?
So in my view, it's made the decline in saving has made people change behavior. That's why we are seeing higher participation. It's making people go back. People who were
Yeah.
sitting on the sidelines, they go back. But I don't think that what is making people consume more is expectations that their long-term income has increased. I think it's more that, the US is an economy addicted to consumer debt, and the fact that they cannot borrow more to buy bigger houses has kind of sort of created a little bit of room for them to borrow more for,
Travel, food.
yeah, yeah,
Stuff.
and I think
Right.
this is what we are saying, what we are seeing.
And then on that, are there, so I mean, obviously I kind of know your general thinking, but I don't want to say like, what would make you concerned that maybe that thinking could be slightly off, in the sense of, if you saw credit card delinquencies or used car loan, like if you saw a big jump or a significant jump in any of those kind of delinquency rates, would that cause you concern? Or, and I know they're pretty low now, I think, and I'm sure they're rising slightly, but
So the way the delinquency rates would work is that it should make banks more careful, and banks should tighten their credit criteria even more than they have done now, and restrict the supply of credit. And yes, delinquency rates are rising, especially on cars, but I mean, look at the data. Credit card, I mean, we recently had the second quarter New York Fed household credit reports. Quarter on quarter, we had a 5% increase in credit card balances. So, I mean, so far the delinquency rate has not been enough to stop the flow of credit. And for sure, there will be, in my view, there will be a reckoning, but the reckoning comes when you have a marked decline in income, i.e., a recession, and we are not there, and we are not going to get there with a sort of fiscal. It was in line with expectations, but you had a big increase in non-housing core services, and housing services didn't inflation did not come down. So Chair Powell must feel really good about, his saying people we can't rely on a few months of data to be confident. I mean, his prudence was really vindicated by the data. I mean, the things that was the release that worked out the best for the Fed was the NFP,
right.
because we had an increase in the unemployment rate and a slowdown in the wage rate to about to 20 basis point month on month. And I have to say, to me, this is the most puzzling aspect of the data we are getting. I'm actually wondering if this isn't in part reflecting the tipping, that a lot of services companies have shifted part of the cost of paying their workers onto tips, that you are seeing
Interesting.
requests for tips all over the economy. I mean, you go and pick up grocery, you are asked for tipping. You buy coffee at a counter, you are asked for a tip. Um, Tips are not taken into account in wage stats or in price stats. They are taken into account in our household income. Unfortunately, data is hard to come by for obvious reason. I mean, no one is keeping track. It's not getting taxed. But I'm wondering if this could be an explanation. I mean, you
Interesting.
don't
I
live
have
in
not heard that. That's definitely makes sense. Yeah.
yeah, you don't live in the US, and but if you did, I mean, you would see generalized requests for tips when there were none before. I mean, even
Right.
people fixing your air conditioning. And I'm wondering if this could have relieved the
Right.
pressure
Right.
on workers.
I mean, it's funny because I always think of everything in the US is around tipping, and in UK, certainly in Europe, is extreme. often that's it. It's just included in the food bill, and I would give a tip, and a lot of Europeans, they say, well, it's already included in their costs.
It's because of minimum wage laws. In the US, if you get tips, your employers is allowed to give you a lower minimum wage, though they have to pay you back if the combination of minimum wage and tips is below the non-tippable minimum wage.
Right.
And there's a big discussion about that because some states, this system is decided at the state level, and some states want to change it and have just one minimum wage level, whether you get tips or not.
Right. And then, so why did risk sell off? Why, especially the long end? It's the prices paid ISM. Is it like because I saw your comments on Bloomberg. So the payrolls is like, almost like Goldilocks, for the Fed. What happened after that, and should investors be concerned about that?
So yes, there's been this discussion about prices paid in the ISM, and it's
Yes.
going up. And there is a little bit of a correlation with the PPI in the sense that we had a big gust of inflation in 2021-22. So everything moved up. And then everything moved down. And now we have a little bit of a recovery in prices paid in both the services and the manufacturing PMI surveys. Not clear yet whether we are getting a follow-through on the PPI, but definitely worth watching.
Right. Okay. Any other data that stood out to you, and then obviously market reactions?
No, I mean, the market is much less concerned by inflation than Chair Powell. And I think the speakers we have next week are probably not going to bridge the gap, so raise the market concerns about inflation. I mean, there are mainly doves. We have, Williams is a prominent dove. We have Logan, who is more of a hawk. And also, to my surprise, Bloomberg included Bullard, even though Bullard is no longer the president of the St. Louis Fed. I think he was such a great click generator that Bloomberg is not letting go of him. So we also have Collins, Harker, who are doves. I really don't see the speakers moving the market
Right.
next week.
Okay.
And the end of next week, by the way, is when the pre-meeting blackout starts. So I'm still expecting no hike. I think the hike comes in November, simply because inflation is tracking the Fed forecast, the SCP forecast of about 4% in Q4. I would add, though, that the surprise in the next Fed meeting could be with the SCP, where we have higher growth forecast for this year and fewer cuts next year. Currently, we have 4. Certainly, Cleveland Fed President Mester at Jackson Hole already indicated she would raise her growth forecast and decrease her forecast of rate cuts next year.
Okay, great. Okay, cool. So then, as we kind of let's continue for next week. What's key data points?
So next week is a bit of a data light week. Most important, I think, is probably the ISM. And again, the ISM is really decoupled from GDP, especially the ISM employment sub-index has decoupled from the services employment. So perhaps the things that will receive the more attention from investors is going to be the prices paid, and let's see if it continues to go up. The other things that will be interesting we'll get the flow of funds data for the second quarter. So we'll get a more complete balance sheet on household than just the debt side that was given to us by the New York Fed. So we'll get more of a sense, perhaps, of why the savings rate is falling. For sure, we will see an increase in household net worth relative to disposable income, to household income. And since already in Q1, net worth was above pre-pandemic levels, so we'll see that households are wealthier. Other than that, there will be non-farm productivity, which is going to be revised down, so will surprise on the downside because of the downward revision in the GDP. We'll get
But
consumer
generally,
credit.
it's pretty hot. But generally, productivity, non-farm productivity is higher than it was pre-pandemic.
Well, yeah, but basically post-pandemic, what we had was a period up to about a year ago when GDP growth was higher than employment growth. So it was lower than employment growth. So productivity was going down, and now we have the reverse. It's just a typical end recession cycle that we have. So yeah, productivity growth is above pre-pandemic trend of about 1%. But it may not
You don't see
last.
this like a 5 to 10 year trend that productivity be higher than it's been the last 10, 15 years.
No, no, there are people who say that the AI revolution is going to lift all boats, and I think we've seen this with it's not our first
Including
rodeo.
ours.
Yeah. So we've seen this before. I'm a little skeptical. Let's see how we do over the next year or so.
Right.
Consumer credit. So yeah, we're going to see another increase in credit card lending. Jobless claim still consistent with a tight labor market. So not many surprises next week. I think next week is when we digest the big data dump we got this week.
Okay. Awesome. Anything else that investors should be
Yeah,
thinking about or
a little bit, but I'm mentioning it because it's happening, but I think it's not going to be a big source of surprise. The end of September is the end of the fiscal year. Congress needs to agree on funding the government. Surprise, surprise, they haven't. No budget, which is very long and difficult to pass. So we have the sort of hard right Republicans in the House who want to shut down the government unless there are big cuts in expenditures. I mean, we've seen this movie before. What's going to happen is that we will get a continuing resolution at the last moment, a short one, and the government won't get shut down because it would really look bad.
will there be changes to the budget or no?
No, I mean, basically what we will have is an extension of current funding levels rather than a vote. The 12 bills we have to make a complete budget. That's not going to happen, not enough time. The thing we might see is a confirmation votes for the new um, Fed nominees, but again, it's a formality. So no, not much next week, hopefully.
Okay, awesome. And as we like to do, I mean, we put out looking through a lot of stuff this past week that hopefully certainly our professional investors have gotten a chance to kind of dig into. But a few pieces to highlight is Bilal's macroscope, which is back, and as always, gets amazing feedback. So he kind of dives into what are the three critical trends revealed by U.S. trade flows. We reiterate kind of a buy on dips view of Naki-Staki. A lot of our model work kind of, just looking through some of the momentum stuff fits in, decent amount of it fits in with our views on US equities versus European equities, but also on treasuries versus JGBs. 10-year treasury versus JGBs, which the trade's been working really well. Obviously, our model portfolio. Henry continues to expand the work on the PCA model and for developed markets, shorter end curves. Eventually, we'll be moving to emerging markets as well. So a lot of like super interesting stuff that people really have been diving into. Bilal put out, I thought earlier in the week, interesting views on dollar yen and why we don't foresee a big move down in dollar yen. Obviously, finishing the week near the highs. So a lot of cool stuff. As always, you always like to say, we really appreciate any feedback, good and bad. We love the interaction, dialogue. A lot of cool, interesting stuff around the horizon for our clients, and wish everyone a successful investing, trading upcoming week.
And a great Labor Day weekend.
Yes, and for all of my compatriots in the U.S., I'll wear the U.S. flag. Don't worry. Yes, everyone have a great long weekend and stay safe.